Hello and welcome to the Look Ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. We're looking ahead to the week starting 22nd of September. So I'm just going to, as always, leave you to have a quick read of the risk warning before we proceed. I'll just pop myself on mute. Okay, so just going back to where we were, we'll just have a quick look at what's been going on this week. Obviously, this week was a very busy week as far as the markets are concerned. We had the Federal Reserve cut interest rates by 25 basis points, first cut that we've seen this year. Now that was obviously fully priced in by the markets. The markets had been expecting a 25 basis point rate cut from the Federal Reserve, because we've seen this weakening in the US labor market. So we saw the Fed cut rates owing to sort of, that weak non-farm payroll report, the downward revision to the payrolls through the month till March, weak jobless claims as well in the previous week, sort of 4-year high. So lots of reasons that the Fed were concerned about the outlook for the labour market. Yet at the same time, inflation sticky at levels that are well above the 2% target at 2.9%. So there was, reason for the Fed to be cutting interest rates to support the dual mandate with regards to the outlook for the labour market. But at the same time, the Fed was concerned, or not sufficiently concerned, should I say, over inflation for it to not be pushing higher. So that's what we've seen, the Fed cutting rates whilst US stock markets were already trading at around record highs. Now the market doesn't seem to be concerned about the fact that the Fed is doing this. In fact, it appears to be pushing higher, really on those sort of expectations that this could help the US economy towards that soft landing that's been looked at now for quite some time. This is the S&P 500. As we can see, it's been a steady push higher. There haven't been any strong gains. It's been a bit of a crawl, I guess, over the last week, but very sure in its sense that it's been going northwards. We've got the RSI in overbought territory, though, suggesting that this push higher maybe a little bit overstretched at these levels. Interestingly, though, there's this theme, I think, also of FOMO, and also this isn't necessarily going up on strong fundamentals because, it's not earnings season. We're not getting strong numbers in, but it's more of a sort of, need to be in a risk asset. And so US stocks is the way to go. Interestingly, at the same time, we've seen the US dollar struggle. The US dollar is trading, it did fall down to multi-year lows, down to a low of 96.21 versus its major peers, has recovered since then. But, we're still trading at weak levels as far as the US dollar is concerned against its major peers. So, just sort of testing this level here, it's trying to get above that 20 SMA around the 97.74 level on the daily chart. We've seen a slight recovery also in the RSI, but really need to have a strong move above this level here, which is around the 98.50 level, in order to really see a move higher towards 100. So as far as what we're going to be watching this week, we also had the Bank of England interest rate decision. They left rates unchanged as expected. We had the Bank of Japan. It was a Bank of Canada as well. It was a very busy week as far as central banks are concerned. But looking ahead to next week now, I think attention is going to be turning back a little bit towards that growth idea, or the growth theme, which we've been away for a little bit due to the focus on central banks last week. But first up, really of interest is going to be the Eurozone PMIs. Expectations, we're expecting to see the manufacturing PMI is actually expected to move up to 51 from 50.7. September services activity is expected to slow just slightly to 50.2, down from 50.5. And the composite PMI, which is considered a good gauge for business activity, is expected to just push a tiny weeny bit higher to 51.1, up from 51 in August. So this is pushing further into expansionary territory. Also, it was a yearly high, what we saw for composite PMI in August. But I mean, you know, this is data which is still very close to that 50 threshold, which separates expansion from contraction. The economy is far from firing on all cylinders. Now, what does all this mean from a policy perspective? Well, the ECB left interest rates unchanged in September for a second straight month because we've got that inflation in line with the target levels around that 2% mark. And growth is by no means, as I said, firing on all cylinders. In fact, it's pretty much stagnant, stalled. So policymakers are going to want to see how Trump's tariffs are impacting both growth and inflation before they take any further rate decisions. There are obviously some suggestions that maybe the ECB is done with their rate cutting cycle, and I think that could depend on the growth outlook in the region. Now, this is the euro US dollar. So we've had this strong move higher, and we broke out of that falling trend line, pushing to a fresh 2025 high of 119.18 before falling lower. Now, interestingly, this fall lower has just found support on this rising trend line that we've seen coming up from August the 1st. So as long as this trend line holds, then buyers are going to be looking to move above that 118.20, 118.30 level. That was the high that we saw back in July, in order to bring that 119.20 level back into focus and the prospect of fresh higher highs. But if we get disappointing PMI data, then we could find that the sellers look to test that 117 level. It's worth keeping in mind, though, that I think, you know, the euro US dollar is a little bit supported by ongoing sort of Fed ECB policy divergence, you know, where we've got the ECB pretty much at the end of their rate cutting cycle, whilst the Fed is looking for potentially 2 more rate cuts this year. Whilst we're talking about Europe, let's also just take a quick look at what's going on in the DAX. Not looking so pretty, this picture. We are sort of seeing a little bit of a move downwards, and I think this is interesting, particularly because we're seeing the US at record highs. So there is this sense of, oh, maybe we're seeing sort of a bit of a rotation out of Europe back into the US as this tariff worries calm. So I mean, this is the DAX that we're looking at here, trading below this falling trend line. There are a couple of levels of support here. You've got the 23,400, 23,450 level. That's the low that we saw at the beginning of September. Below that, you've got the 23,300. That's the low from September. So and it's also a low that we saw back in August. So a break below that, I think, would be quite significant, opening the door to that sort of 23,000 level on the downside. As far as on the upside, you know, if we get encouraging data from Germany, particularly German PMIs, which are also in focus, then this level up here, 24,000, pretty key. You've got the the 50 SMA. You've got that rising trend line going back to late April. And you've also got the round number there. But as I said, RSI is looking like momentum's to the downside, and we're below that falling trend line. So just be watching out for those levels of support. So we've also got the UK PMI data. Now the pound is struggling, and I think there are quite a few reasons for this. Obviously, this week we had the Bank of England leave interest rates unchanged at 4%. This was as expected. Inflation this week is proving to be sticky, 3.8%. We've got wage growth is still high at 4.7%. 4.8%. Unemployment so at 4.7%. So it's sticky inflation. Not really showing too many signs of cooling. Service sector inflation again up around that 4.8% level. So not really consistent with levels that the policymakers will be comfortable cutting interest rates at again, especially after they cut rates in August. But at the same time, we've got stagnant growth. As far as GDP is concerned, the July GDP figure was 0% growth, so not looking too great. And then on top of all this, we've also got these fiscal concerns, which have really weighed on the pound and could continue to weigh on the pound, I think, over the coming months. But as far as PMI data is concerned next week, we've got expectations for the services PMI is to fall back slightly. Let's just pull it up here. Okay, it's not up here yet, but the expectations are for service sector PMI to come down from 54.2 to around the 53.9 level. Manufacturing PMI is also expected to ease from 47 to 46.9, and the composite PMI is expected to ease from 53.5 down to 53. Now, the rate of expansion that we saw in that composite PMI was around a yearly high, but as I said, there could be signs of caution starting to seep in, and that is because of the November budget, which is unhelpfully late at the end of November, but also comes after recent government borrowing data showed that the government borrowed much more than expected in August, and over the first 5 months of the fiscal year, I've borrowed around 11 billion more than expected so far. So more than what the OBR has forecast. So this basically means that there is an increasingly likelihood that the government will be needing to hike taxes or at least cut spending quite severely. So fiscal concerns, as I said, could weigh on sentiment and the outlook and deteriorate, especially with the outlook deteriorating. So, I mean, what this all means from a policy perspective is we're not likely to see the Bank of England move on rates anytime soon. There's only an 8% chance of a 25 basis point cut in November. Oh, sorry, this is the fire alarm.
Attention, please.
Just bear with me.
Attention, please. The fire alarm is about to be tested. Please take no action.
So there's no rate cut expected really in November, particularly as the Bank of England are going to want to wait to see what the autumn budget actually brings later that month before moving. But at the same time, oh, sorry.
Attention, please. Attention, please. We are investigating an alarm condition. It may be necessary to evacuate the building. Please await further announcements.
But I think those fiscal concerns over growth.
Attention, please. Attention, please. We are investigating an alarm condition. It may be necessary to evacuate the building. Please await further announcements.
Could keep pressure on the pound.
Attention, please. Attention.
Okay, so which is why we're seeing it sort of struggling. Now, if we have a look at that chart as well, if we just have a look at this candle here, the shooting star candle, which is almost there.
Attention, please. Attention, please. The fire alarm test is now complete. Please respond to all future fire alarms.
So as I was saying, that shooting star candle is often a potential reversal And that is what we're seeing now. We've taken out the 50 SMA, sorry, the 20 SMA, finding support here on this falling trend line, dating back to the 2025 high. Also, the confluence with the 50 SMA, so pretty important level there, and that is being seen there at this level here, which is the 34.65 level. So if we get a breakthrough there, and then also this 34.30 level, which is the level, as we can see, which has been supportive over recent months, that could open the door to a deeper decline to 133.60. So especially if we get weaker than expected PMI data, then that could upset demand for the pound and see the outlook deteriorating ahead of the move, the autumn budget from the Chancellor. Another one to be looking at here is the US dollar, Japanese yen. We do have the Tokyo CPI report. Now, interestingly, this is it's considered a good lead indicator for the national CPI data, so for national inflation, and it's released on Friday. Basically, the data comes after the Bank of Japan recent meeting where they left interest rates on hold, and ahead of the October meeting, which is on the 30th of October, but which is still some time away. But it's a rate decision which the Governor Ueda has emphasized. You know, the central bank will be watching the data effects from US tariffs. So far, the Ueda has sort of suggested that the economy is bearing up well against the impact of tariffs so far. So, I mean, if we see hotter than expected inflation, then that could help strengthen. Here we go. It could help strengthen the case for a hike from the Bank of Japan, and they are still expected to hike. And if it's not going to be in October, which it may not be, due also to the political uncertainty that there is in the country after Prime Minister Ishiba resigned the other weekend, then early next year there is potentially still space for the Bank of Japan to hike interest rates. So, I mean, interestingly, we are seeing here that the pair has been very well matched, trading in this holding pattern around the 146.40 level, around 148.65 on the upside. So we're being capped on the upside by this 200 SMA. That's the level that buyers are going to want to break out of if we see a weaker than cooler than expected inflation. So that'd be the 148.60, creating a higher high, opening the door towards 150. On the downside, 146.45 is 25 is the levels we're watching on the downside. That opens the door to 145 if we get stronger than expected data. And I think another thing that we will be watching, and this is the key major data point next week, is the US core PCE. Now, US core PCE, that's the Federal Reserve's preferred gauge for inflation. This is actually, it's on the Friday. So the fact that it's on the Friday does mean that we could potentially have this sort of waiting week as far as US data is concerned. So you know, as far as stocks are concerned, as far as the US dollar is concerned, we might find that they're sort of struggling for direction across the first half of the week, especially as we have to wait until the end in order to get this core PCE figures. Now, core PCE in August came in line with expectations, and that was at 2.9%. What does it come in at? On a monthly basis, it was in at 0.3%. So there is a possibility that it will come in at 0.3% again. Data comes, as we know, after the Federal Reserve cut interest rates. So, you know, if we do see a hotter than expected print, I think that could get the market a little bit nervous to see the Federal Reserve cutting rates as inflation's getting hotter. Now, I mean, if we think about the outlook for inflation, there is still expectation for inflation to climb owing to the impact from Trump's trade tariffs. However, the Fed is clearly expecting that to be temporary, given that they are cutting rates in order to support the jobs market. But if we do see significantly hotter than expected inflation, I think that could raise concerns of a stagflationary outlook, which may make the markets a little bit nervous. But if we get cooler than expected inflation, then I think that will really help boost equities higher, pull the dollar lower, because the Fed have said that they're interested in, or they've signaled that they may cut interest rates twice more, but obviously that's going to be dependent on the data. And if we get cooler than expected inflation, that's what's really, it's sticky inflation, which is holding the Fed back from doing more to support the jobs market. So if we see cooler than expected inflation, the Fed will then be able to, and the market will be comfortable with the Fed doing the additional rate cuts that it's looking to do in October and in December, and that could see this uptrend continue, looking towards the 25,000 level as the next logical move higher. Also, just watch there, we've got the RSI in overbought territory, so period of consolidation, period of even a pullback, but I think any dips are going to be considered to be buying opportunities at this point, given that there is no technical indication that that this is going to be reversing. So there's no sign of no sign that this is in reversal. So those are the main points to be watching out for next week. Just going to have a look here at gold. Obviously, we need to look at gold because climbed to record highs earlier this week, up at the 3,700 level. We have seen it just pull back slightly. The pullback sort of came back to this level here, 36.30. As far as sort of levels to be watching of support, yeah, around that 36 sort of 27, 36.20 level, that could be a low that we've seen in the latter parts of in the last 2 weeks. Again, this was very overbought, so understandably a pull lower, but fundamentally I think there is still a lot of reason to be behind gold, in the sense that central banks are still buying. We're seeing less interest towards the US dollar, which is flat on the week, and we're also seeing those ongoing concerns over geopolitics, but more importantly debt levels globally, which are very high, and so moving into non-fiat investments seems to be potentially an interesting, and it's helped drive gold higher so far and could potentially continue to do so over the coming months. So that is everything from me. I hope that you've enjoyed it, and I will see you next week.